Hey folks, this is Dr. Jeff Camarda with a piece called Cheery News for Investment Land. The best is yet to come. Now the market's been on a tear since 2009, nearly tripling since the bottom, and with such good recent performance, which is what humans are hardwired to focus on, it's hard to believe that the past couple of decades have actually been pretty crappy. But people tend to forget the dismal period between the Y2K bust of 2000 and the huge plunge of 2007 and 2008. But we're coming off 20 of the worst years for compounded returns since the Great Depression, says Nicholas Colas, co-founder of DataTrek Research. According to Barron's, the average trailing 20-year market compound annual growth rate since 1928 is 10.7%. That's right, an average since then. Stocks since over the past 20 years have returned close to 11% per year on average. The poor recent performance compared to long-term 10.7% has, I quote again, given birth to, among other things, the use of passive investing and the growth of exchange-traded funds. The best thing about sitting at the low end of an historical range is that mean reversion should start to kick in, and the next 10 to 20 years from here will likely be pretty good. Also, that quote from Barron's. In other words, the recent return has been lower than the historical average, and it's likely that we'll see reversion to the mean, which means higher annual returns going forward from this perspective. Again, that information from Barron. So Camarda believes that this blasé period, the statistical fluke that's made unmanaged index investing look so good, is about over, and that the years to come will be much more profitable for those that choose investments with deep rigor and carefully, prudently, as Camarda endeavors to do. The current period seems like a most opportune one for this strategy. Even with a recent downdraft, Barron's notes that cheap stocks have been marked down more than the expensive ones. The valuation gap between the cool stocks and the outcast has rarely been wider, which is music to our ears to value investors like Camarda. Especially in times of volatility or bear market behavior, the cheap end of the U.S. market may indeed be an appealing refuge. The nice thing about cheap stocks is that they're fit for both the greedy and the scared. There could be outsized returns. If everything tanks, there is comfort in holding companies that could pay for themselves with their cash flow, end quote, and with the dividend flow, of course. On that final note, I should say, we point out that Camarda's new, nearly a year now since we began testing, but relatively new, Camarda's Caesar stock portfolio is strongly biased to stocks that not only are very, very fairly valued, they're cheap in our estimate and our analysis, but also have rich dividend cash flow. And I hope, again, that brings you some cheery midwinter news. And until next time, this is Dr. Jeff Camarda. Thanks so much for watching.